Hello. So welcome to this Q&A video on the Financial and Retirement Planning Calculator. Now, just kind of as a quick update on the program overall, the Financial and Retirement Planning Calculator is still, in my view, in kind of its infancy. So it's been launched. We have a pretty good working model, I believe, but there's going to be a lot of attention given to this program. I'm thinking probably after the tax busy season is over. Right now, I know many people are like heads down in taxes, and that's kind of where most of the focus is in the tax prep class right now. So this will get a lot of attention though, and there's going to be more videos that are both conceptual about financial planning and technical in nature and everything. So there's a lot coming with this program. If you're in this program, you are in the early bird, and there's lots to come. And financial planning, just like tax planning, is going to be, a lifelong endeavor that you'll revisit from time to time throughout the year as, the facts and circumstances of your life change. And of course, this year, there's a lot of speculation about what law changes with tax specifically, which is part of financial planning, are coming under the new administration. There's been like everything under the sun has been proposed. So it's really hard to know at this point in January of 2025 exactly what's going to happen, but we shall see. 2025 is going to be an interesting year from both a tax and financial planning perspective, in my opinion. So lots to come this year. But let me just address these questions because I want people to be able to keep moving forward with their planning. So I'm going to start, basically right now, there are two versions of the Financial and Retirement Planning Calculator. There's V1, and then there's one version that's been updated that's actually located in the Q&A section. And so I was having a little trouble, particularly with this line reference, but I think I figured out what is being asked. And we're going to go over the more updated version because I think that's the one. It may be this one. Let's take a look at both real quick. So I have V1 back here, and let's just read this question. After downloading the most recent version, I think there must have been an update. I'm still struggling to understand the math in the cash flow projector line 135. So I think this is referencing the first version because 135 right here above this line is a summation of the three lines above it, after tax cash flow before personal expenses. I think that is the line that's being referenced. However, it says the calc should be 130 through 134 and not 132 through 134. Let's see. So right now, we have the sum of 132 to 134 in there. And the question is, should it be including 130 as well? And I don't completely understand. This one right here, this summation in line 132, is the sum of all the lines above it up to here. So I wouldn't sum from 130 all the way down to 134. I think that's what it says. Yeah, 130 to 134. So I'm not completely sure on this why you're thinking it should be 130 through 134, because that would be double counting some of the numbers. If we look right here again, like that's already the sum of all of these. So we're just starting with that sum and adding in these two right there. So I don't think that line reference works on the original one. Let me look at the newer version. And see on here, the sum, the grand total sum is actually in 138. And so the reference from, let's see, 130 to 134. Let's see. So I'm not, those references don't line up here exactly. And so I'm a little bit confused about that. But I still think I can answer the questions that are being asked here. Let me read this other one first before we get into the responses. Another question in the cash flow projector, the purpose of line 40. I'm struggling with this reference as well. We'll go look at line 40 in a minute. But it does say removing the investment income from cash flow. And that I can find. That one I saw. So we will go to the removing the investment income from cash flow. I don't understand the comments in the video. I'm stumped on this one because at the end of the day, we should be looking at total income minus total expenses equals after-tax cash flow. And on a simple calculation, I would agree this makes sense right here to think about it like this. So I want to go into the nuances of why it may be a little different than this. By removing the investment income, the total income line is incomplete. Okay, so let me start with removing the investment income from cash flow. And in addition to that, because here it is right here, this is the investment income, less investment income going into cash flow. And that's actually the same on both versions. I'm going to stick with the, this is the updated version that's in the Q&A area, dated 11/30/2024, because it's got a little more, it's got a few extra additions in there. So I can also address, well, as part of addressing this particular question, we're also kind of addressing what goes into the sum. In fact, we kind of need to step back and look at this whole column, I think, to really answer this question. Okay, so let's jump into the answer. The way that I want to think about this is, let's just start over here on the projector, on the net worth projector. And I want to walk through in concept what we're doing here. And I want to be careful not to say like, this is the right way, quote unquote. I'm sure there's lots of ways that we could do it. And depending on the way we do it, and what the lines are called and what they represent, the way we think about it could vary. So I want to go through the way that it's currently set up so that the question that is being asked makes sense. So let's just start right here. In this tab, what are we trying to do? We're trying to, in the first section, let's forget about the projection out here into the multiple future years. Just in this first area, what are we trying to do here? We're trying to take the market value of all of our assets, less our liabilities, and then we're trying to add or subtract to that changes for the current year to arrive at a market value at the end, right? That's pretty straightforward. So if we start with this market value, whatever that is, the first thing that we're adding right here is investment income in the form of interest, dividends, and capital gains. We're calculating the return right here on this sheet. And if you can see the summation of those right there, 3,990. Okay. Now, if we follow the math across, this column is a market return, like fluctuations in market value. This is a cash flow return, meaning like interest and dividends, outside cash being socked into the portfolio independent of movement in the market. This is the movement in the market column. Okay, let's just ignore the other columns that are here that don't have any numbers for the moment, just to stick to what we do have. Then right here, This is an allocation of free cash flow from over here, which we'll get to in a minute. This is basically everything that is left over after all of our expenses, right? So we cover all expenses, and then if we have cash flow left over, it has to go somewhere. It's going to go into one of our accounts, right? Here I've chosen to put it into a portfolio account, $5,000. But this, in our setup, if you don't specifically allocate it to another account, the catch-all default bucket will be checking 1. Okay, that's just how the template is set up. You can make the default something else if you want. You can specifically allocate this 45 to like all of these lines if you want. But if you don't allocate it somewhere, and I'll show you how to do that over here, it's going to end up here. That's the catch-all bucket. Okay, and then when that's done, we'll get into reallocations later. Let's not worry about that. The point is we're going to sum across, and we're going to sum up everything basically except for the few things that we have left off for reasons we can talk about later. Beginning balance plus interest and dividends plus any market return or loss if there was any, plus whatever cash is allocated from the outside to this particular account. And that leaves, plus a reallocation from another account is what's in that one. That leaves $57,000 in this account. Let's just focus on this one account real quick. So basically, I had $10,000 at the beginning of the year. I had $150 of interest, dividends, or capital gains go in there. I allocated $45,000 of free cash flow from an outside source outside of the account. I did a reallocation from another account of $2,000, and at the end of the year, I was left with $57,000. Okay, and the reason I want to go over that is because what I want you to see is that this $150 of interest, dividend, and capital gain, the investment income, has already been included in this total. Okay, it's already in the total, and let's extrapolate that to say that this entire amount, which is $3,990, this investment income is already included in the total at the end of the year. Okay, now that we have that in mind, let's go back over here real quick. Okay, remember that number for this example. Remember that number, $3,990. Now let's go back over here to the cash flow projector. So over here, we bring in all of our income for the year from various sources. We have our W-2. Now right here, if I add all these up, what is that? That's the $3,990 of interest, dividends, and capital gains. We have to bring that over here so it can be taxed. The amount that is going from here into the total is a pre-tax number right now. You see how this hasn't been taxed. This is just a raw return. So, and let's put it this way. We're not taxing this investment income on this page. Therefore, the pre-tax amount is ending up in here, and we need to make an adjustment somehow, somewhere else. And that's what we're going to do over here. All right, so first I bring it over here, the $3,990, to tax it. Then we have, here's business income, lots of other things, rental income. This is income from a Roth conversion that is it has to be taxed because it's a Roth conversion. But when we go back over to the net worth projector, I want to specifically point this one out as well. Where is the Roth conversion? Let's see. Let me find it. Okay, the Roth conversion is right here. So here is, let's just go over this and then we'll go back to the other page. Here's a traditional IRA. Okay, if I decide I want to do a Roth conversion, what is a Roth conversion just mechanically? It's taking money out of a traditional IRA and putting it in a Roth IRA, right? And so that's what we're using this reallocation of assets column for. That's one of the things we're using it for. We're using it for any redistribution between your accounts. But a Roth conversion, so I have $10,000 coming out of a traditional IRA. And the way that I have set this up, just for example purposes, is I have put 8,000 of it into a Roth account. Okay, so it went from a pre-tax account to an after-tax account, but not all of it went there. Only 8,000 went there in this example. Why? Because I assumed there's going to be some tax. I mean, there will be tax, right? But there will be a need to pay cash tax from an outside source or through withholding at your broker. Although a lot of brokers apparently don't like to do withholding on these. People keep telling me that. But for purposes of tracking, we're going to pay $2,000 from an outside source. So whether they withhold or not, if I take $10,000 out and I put $8,000 in the Roth, I'm going to throw $2,000 into my checking account and keep it there until I need to pay the taxes. So that's like the mechanics of $10,000 comes out of a traditional, $8,000 goes into a Roth, and then I just decided to put $2,000 in here for this example. If you had other outside funds, which we very well might in this example, but I was trying to demonstrate that possibility. You could just do 10 out of here and you could put 10 straight in there and it wouldn't have to put any in the cash account. But even if you did that, regardless of how you distribute it between the Roth and the cash, this item is $10,000 of income that needs to be taxed, right? So, but it's not being taxed on this page. This whole 10,000 is ending up in there. Is coming out of that total because it's negative. This 8,000 is ending up in there, and this 2,000 is ending up in there. Nowhere has the tax implication been handled, but it is handled over here. We bring the $10,000 that came out of the traditional over here so it can get taxed. Okay, so let's keep that 10,000 in mind. The two numbers I want to keep in mind for this example are this grand total, which is $3,990, plus this 10. Okay, so now we get down here, and this is all of the items that we want to tax. Okay, all of our taxable income items are in this row. Now, here is where we defer. So we're choosing to defer into a 401k plan in this example, plus some for spouse 2. We're putting some money in a traditional IRA. We're putting some money in an HSA. And so these items are all reducing taxable income because it's deferral, right? So we should see 303 less the sum of these, which is 40,000. So that gets us down to 263,990. Okay, so that's what's actually subject to tax before a few other little adjustments right here. So 1/2 of self-employment tax deduction. I'm not going to focus too heavily on that. This number right here, this is the issue of you can defer money into a traditional IRA, but whether you can deduct it or not depends on your income. And so in this case, the calculation is set up such that this person is unable to deduct this 7,000. We put it up here in the deferral section because that's where it would normally go, and that's where it should go. And this is ultimately how it ends up in the account anyway, right? Like this 10, this 20, and this 7 are brought over here, and they are put into these accounts. This is adding the 10, the 20, and the 7 to this account. So you can put the 7 in there. Whether you can take a deduction for it or not is a different matter. And in this case, the person can't. And so we're adding that back to income. And then we have the standard deduction. So this minus this plus this minus this gets to 241. 643, okay? And don't worry, I'm getting to your question. We're almost there, almost at that question. So then we have an effective tax rate, which we'll deal with when we get more into, when we start really doing some updates on this. We'll try to refine how you determine what your effective tax rate is. You can just take your, like your total tax divided by your taxable income from last year's return, and whatever percentage that is can be like an estimate for what your effective tax rate would be, unless you're expecting, large variations in your income for the year. But we'll get into that later. So basically, we have a rate here, some kind of effective tax rate, and so this gives us tax. This is how much tax we're going to pay, right? Now let's think about what's happening next here. So I have two entries of withholding, and they're negative. And then let's look at the formula in this cell. After tax cash flow, before non-taxable income. Okay, so we're taking the taxable income right here, and we are subtracting off the sum of these items. So if I break out the math, I'm subtracting this 45, but I'm adding both of these 10s because it's minus negative numbers. Okay, so we're taking taxable income, we're subtracting off this tax, and then we're adding back two instances of withholding. Now, does that make sense? Let's think about that. What is this number right here? Well, this is mostly cash. The taxable income, it's mostly cash. Which part of it is not cash? Well, this part, let me think about that. It is cash, but it's being handled on the other page. Let me rephrase what I was about to say. This is cash. Okay, but we have to make a few adjustments to it because of things that are already being handled on this other tab. Okay, so let's say the $263,990 is cash. We have to subtract off the $45,000 of tax because that's going to be cash tax going out the door. However, if we have withholding is money that already went out the door. Okay, so the amount of tax that we ultimately have to pay in cash is reduced by withholding. Okay, now that I'm thinking about this out loud, we may even need to add a line for like estimated tax payments right here. Anything that was already paid in. So again, if I have to pay $45,000 in tax, but I've already paid 20, that leaves 25 that I have to pay. So of this cash, I have to pay 25. That leaves 238 left, right? That leaves 238 of cash. When I start here, I take away my tax. I add back I basically reduce the amount of tax I'm taking away. And this is what I'm left with in cash. This is my after-tax cash flow. However, we need two more adjustments. There's a couple of possible other ones, these here, which we don't have any in this example. This is income. This is cash you could receive that isn't taxable. Tax-exempt interest from muni bonds, gift income that you got from somewhere, child support. Those are non-taxable items, but they could still be cash, so you could put them in here to increase this amount of cash if applicable. Okay, so now this is our after-tax cash. However, the problem is that let's fast forward before we talk about these two numbers. Let's fast forward from this 238 all the way to the very bottom after all the expenses. This is what is left, 45. Okay, this 45 gets carried over here and goes in our catch-all bucket. That's the amount of cash that we have left after all expenses in our budget for the year. Okay, so think about that 45. That 45 is being brought over here. And what was that 45 if we scroll all the way back up again? Well, it was basically this 238 minus all of our expenses. But there's a problem. This 238 includes this investment income. It also includes this Roth conversion income of 10, doesn't it? Because we already said that $3,990 is already in the grand total for 2024. And that $10,000 never actually left the accounts taken as a whole. It just went from one account to other accounts. The only reason we brought it over here was to tax it and to get the tax effect of it. So if we treat this as cash on this page, and we treat this as cash on this page, then we're double counting both of those items, right? So just as an example, right here, I'm taking both of those items away. I'm saying this cash really has to have these two items taken out, since those two items are already over here. Okay, if I don't take them out, if I did not take these out, and this final number was 238,394, and then I did all of my same exact expenses, then what would happen? This is about $14,000. The grand total at the bottom would be 14,000 bigger. This would be 59,000, right? Let's try that. Let me just take those numbers out. And we'll see that that's going to be 59,000. I'm just going to put a 0 there and a 0 right there. So now we go back to the bottom. That's 59. That 59 is being brought here. And so that 3,990 is not only in here once, it's part of this 59. And so it's in there twice. And the 10,000 Roth conversion, which never left the sum of these accounts anyway, is also being, another 10,000 is being brought back over here, which it shouldn't be. That would be double counting that 10,000. It's also double counting that, okay? And so that's why, to answer that question, let me see if I can just hit undo and put those back. Undo, undo, okay. That's why we're taking this out. This was the item being asked about. We're taking this out since it's already over here. It's already there. All we did was bring it over here to tax it. And so the tax effect of it is included in this number, which in this tax number, which we're reducing these cash flow numbers down here by this. So the tax effect of that interest income is being removed right here and is therefore not left in our after-tax cash flow, but we have to take out the source number too. Because of the way we've set it up, we have to take out the source number. Now, if I didn't set it up this way, and we started over here with all of our income, and this wasn't here until later, then we wouldn't have to take it out. We're taking it out because of the way that this thing is set up. We're projecting our return over here pre-tax. It's in there already. I hope that going through that line by line like that made it clear that that 3,990 is already in the grand total here for 2024, and that's why we have to take it out right there. So the question was, let me pull that back up. The question was, by removing the investment income, the total income line is incomplete. Well, let's think about that. So when we look at these two tabs in combination, the way that I would look at it is to say, I know that 3,990 is already here in my account balance, and it's going into the account balance at the end. And I agree with you, it's no longer in this because we've specifically taken it out. Okay, so this is my after-tax cash flow, excluding these expenses. But the way that I was thinking about this is, so just using the numbers we have right here, I have $224,000 of after-tax cash flow before personal expenses. Okay, and I agree it doesn't include this number. Then I start figuring out what all of my expenses are, right? And in this example, we have 168 leaving after-tax cash flow of 55, but I have chosen to put 5 specifically in a brokerage account and 5 in a Roth IRA. This is where I'm allocating specifically to those other accounts, as I mentioned, and those specific allocations come over here. And here, these lines are linked to the cash flow projector. So whenever you specifically allocate to a certain account, it gets brought over here. That's where these 5s come from. And so what if I, like, here's the catch-all. So if I allocate 40,000 to this bucket, then there's only 5 left in the catch-all, right? And we go over here, 40 is in that bucket and 5 is in the catch-all. So let me just put that back to 0. So the point I'm trying to work toward is, let's say that that instead of, let me just add one more expense, and let me just make the expense a little bigger than this. So let's just say it was 170. I'm just making up an expense so that, let's see, this number, wait a minute, that's much too big. That's not what I wanted at all. I want this to go slightly negative. So let's make this expense 57,000. Okay, so now my expenses for the year are more than my income. Okay, which, frankly, for a lot of Americans, that may actually be the case, but hopefully in pre-retirement years, it's not. But assume that it is for a minute. Assume that your expenses are more than your income for the year, and therefore you have gone negative right here. Now, let me just take out these special allocations here for a second. Okay, so what I was envisioning, basically, is let me say this 2 ways. First off, I was envisioning that the point of doing this analysis is to help you get on track so that in pre-retirement years, this is always a positive number and your net worth is growing in your pre-retirement years. And then when we get over here into these, it's built more so that it's built with the expectation that net worth could be going down in your post-retirement years when you are using up assets, and it would be expected that your expenses could be in excess of your income in retirement. Therefore, where do you get the money? It comes from the assets you've been accumulating in pre-retirement years. But just for conceptual purposes, let's say this number is negative. Your after-tax cash flow for the year is a negative number because your expenses were more than your income. So then what I'm envisioning is, like, this amount still has to go into your net worth. And so I think it'll still just be brought over here as a negative number, and it'll decrease your net worth. But I guess what I'm trying to say, and maybe I'm not doing the best job of saying it, is it's like this income, which we don't have over here because we took it out, this is effectively being used up now, right? Like, or the cash that was there at the beginning. It's not building these assets, it's decreasing them by the fact that you brought a negative number over here because for the current year, your expenses were more than your income. And so the question was like, well, what about this income? Why can't I use that over here against my expenses? Effectively, you are. If you don't have enough from every other source to where this goes negative, and then it gets brought over here, effectively you are using this up, right? Because this is now decreasing your net worth from 23 to 24. That's what I'm trying to get at, is that this is available effectively to use, but I kind of built the spreadsheet under the assumption that you probably, hopefully, have enough income excluding this such that you're still positive down here on this line, and therefore you've covered all your expenses and still have a positive number to allocate to increase net worth. If you don't, you're going to allocate a negative number and you're going to decrease net worth. And so, as I mentioned, this income is effectively going against that anyway. But the real crux of the issue is the reason we back it out is because it's already here, we would be double counting it if we left it in this number, which ultimately ends up right there. That's why we back it out. That's also why we back out the Roth conversion income, because the Roth conversion income is only brought over here to be taxed. The actual cash simply moved from one account into another on this page, and we would be double counting that because it would be brought over here in this number too. We would be double counting that if we didn't back it out. And so that is hopefully clear, despite it was long, but hopefully a clear explanation of why we're backing these two items out of income, and also hopefully clear that they're not going missing. They're just over here already, which is ultimately where we're bringing the final answer anyway. And so hopefully that makes sense. Now, let me go back to the other question real quick. Okay. So again, these line references, I wasn't completely clear on them. If we just look at that part one more time, like this is the sum of all of that, and then this is the sum of those. So I'm not sure what those line references are referring to exactly. But hopefully by going through that, maybe it kind of makes that question, maybe that question was answered already without me having to specifically try to pinpoint what those line references were for. Again, you're always welcome to ask again if now that we've gone through this sort of explanation. As far as this question goes, are you planning to provide release notes and so forth? So the way that I have been doing it in the personal tax planning template program, and the person who asked this question, I'm not sure off the top of my head whether you're in the personal tax planning template program or not, but either way, the way that I do it over there, that program has been around longer. There's been more updates. I'm anticipating approaching this one in the same fashion. What'll happen is as we go through an update, let's say I decide to add a couple rows right here for some reason. I'm just making something up. I will make a video that shows what I'm doing. And the reason I want to do that is because I don't want people to have to start over every time I make an update. So I'm going to do a video detailed explanation showing how to make the update so you can make the same update in your version and therefore you don't have to start over. Now, I will upload the updated version of the template so you can download it if you want. For people who are new to the class, they can just start with the updated one. But this Excel file is not hosted on any kind of like cloud server. I can't update it like in a central location and like push it out to everybody like, like a regular software update. I'm not, we're not quite at that level of sophistication in this course right now. This is not a cloud-based thing. This is just a local file on your computer. So the only way that I can make updates and do it in a way so you don't have to start over is to show you how to do it in a video. And so I'll just make a video of myself making the update and explaining step by step what I'm doing. And then you can just make the same update in yours. You can always download the new version and compare it to yours if you want to, if that's helpful to you. But that's the only method I have to allow people to update it without having to start over. And so the way that'll work is inside the class, as it gets more built out, there'll be a section that'll just say, it'll have like the date, and it'll say there's been an update on this date, and there'll be a video associated with that will show you what the update is, along with further explanation, like why we're making that update or how that update came about or whatever. As far as the, just as a general statement, I'm sure there will be updates. There's always something to add. But as a general statement, I think the updates to the cash flow and retirement planner, or the financial and retirement planner, are probably going to be less common and less frequent than the personal tax planning template. And the reason I say that is because the cash flow this entire workbook, the financial and retirement planning calculator, essentially all of this is math. This is all just mathematics in here for the most part. The personal tax planning template is law, tax law, and tax law can change, whenever they decide to change the law. And so inherently built into that one is the notion that as tax laws change, we're going to have to make changes to it somehow. With this one, there are a few items that are tax related. And so, if a law, we might have to tweak a line or something like that. But the way I like to think about it is this row right here, basically like this row, if you blow this row up, this row is the personal tax planning template program. The entire personal tax planning template program effectively all boils down into this line and whatever that number is right there. And so, like, when you think about it like that, the tax component of your overall financial plan, I have a whole program on that. But at the end of the day, when you go through all that stuff, ultimately we're just trying to work down to this line and minimize the amount on that line, the percentage on that line to the extent possible. But the answer gets brought in here for purposes of calculating a tax so we can figure out our after-tax cash flow. But the point is that, because this is primarily math doesn't really change over time. You know what I mean? So that's why I'm expecting fewer big updates. This might be like minor tweak updates, which should be relatively easy to follow in my videos. This is not going to change as much based on law. And that's the real big difference between the tax class and the financial and retirement planning class, is most of this is math and the other one is law. So if that's helpful, hopefully, to just kind of provide you with a little guidance on what I'm expecting going forward. But there's lots to financial planning that we can consider. But after you consider all of those things, I expect lots of videos on financial planning. But once you decide something when it comes to financial planning, to record it in here is just math. It's not really law, so to speak. So anyway, I may have gone on a little too long about that, but hopefully it provides some insight. So that's where we're at. Hopefully that clarifies why we're backing this out. If you have further follow-up questions, feel free to ask. And like I said, I anticipate that the video content related to this program and new content related to financial planning in general is probably going to be like a post April 15th, maybe over the summer is really when this program is going to start kicking into high gear, is my expectation on timing. So, all right, hopefully that was helpful.